This week, we are diving into a market that feels like it's being pulled in two completely opposite directions. Seriously, on one side, we've got this incredible tech and AI-fueled rally, pushing stocks to all-time highs. But on the other, there's a storm of political turmoil brewing all across the globe. So how can these two things coexist? And more importantly, which one is going to win out? Let's get into it. Citadel CEO Ken Griffin really hit the nail on the head with this one. He's pointing out that the US is using the kind of stimulus we'd normally see in a deep recession, but we're at near full employment. It suggests that while everything feels great on the surface, this sugar high, as he calls it, might not last, and that's making seasoned investors like him pretty uneasy. And this really shows you the core conflict we're dealing with. On one hand, the risk-on story is just undeniable. The S&P 500 is hitting record highs, all powered by this massive surge in AI stocks. But then you look at the other side, and we've got some major risk-off problems. A government shutdown in the US, political chaos brewing in Europe, and investors are starting to pile into safe haven assets. It is a classic tug-of-war between tech optimism and geopolitical gloom. So, to make sense of all this, here's our game plan. First, we're going to dissect that powerful AI rally. Then, we'll pivot to the political headwinds coming from the US, Europe, and Asia. After that, we'll try to decode what investors are actually feeling, and then we'll wrap up by looking at the key things to watch in the week ahead. Okay, first things first, let's talk about the engine that's really driving this market. Despite all the negative headlines, there's this incredibly powerful narrative around artificial intelligence that's sending stocks into the stratosphere. It seems like in a world full of uncertainty, AI is this one single tangible growth story, and investors are willing to look past almost any political risk as long as that story is alive and well. And we're not just talking about a one-day wonder here. Nope. The S&P 500 has now closed higher for 7 straight days. That's its longest winning streak since back in May. This just shows you there is a persistent, resilient buying pressure out there, with traders completely laser-focused on the upside in tech. The main event, the thing that really fueled this week's frenzy, was a blockbuster announcement. Chipmaker AMD and the AI powerhouse itself, OpenAI, have signed a massive deal to build out new AI infrastructure. Now, this is a direct shot at NVIDIA's dominance in the space, and it sent absolute shockwaves through the semiconductor world. And just look at the market's reaction to that news. AMD's stock shot up nearly 24% in a single day. I mean, that is a clear signal of the immense value the market is placing on any company that has a major role in this AI build-out. It's just a staggering move, and it really underscores the power of this whole narrative. And get this, it's not just the chip makers. OpenAI's influence is so huge right now that a simple mention by CEO Sam Altman at a developer conference sent a whole bunch of other stocks soaring. Companies like Corsair, TripAdvisor, Booking.com, and even Peloton saw their shares jump just because they were named as partners for ChatGPT. This is the power of the AI story in action, a ripple effect that's touching every single corner of the market. But now, let's look at the other side of the coin. Because while that AI party is raging on, there's a trio of pretty significant political risks, creating major headwinds. And it's definitely giving investors a reason to pause. So first up, right here in the United States, the government shutdown has now entered its second week. The big problem here is that it's halted the release of crucial economic data, like the monthly jobs report. This is effectively blinding investors and, more importantly, the Federal Reserve to what's really going on with the US economy. We're flying blind. And without those official government numbers, we're left with private data. And frankly, it is all over the map. The consensus from economists was for about 54,000 jobs to be added, but the Carlyle Group estimates just 17,000. And then ADP comes in and estimates a loss of 32,000 jobs. This huge disagreement just shows you how confused and uncertain the market is right now. Now let's hop over to Europe, where the situation is looking just as precarious. France has been plunged into a political crisis after its prime minister resigned, what's being called a complete disaster for President Macron's government. And this is all happening while Germany, the continent's biggest economy, is showing signs of weakness, with factory orders falling for the 4th month in a row. This chart right here really visualizes the market's anxiety. It shows the yield spread between French and German 10-year bonds, which is a key risk barometer in Europe. So the fact that the spread is getting wider tells us that investors are demanding a higher premium to hold French debt compared to safer German bonds. You can think of it as the market's risk tax on French politics, and right now that tax is going up. It's a flashing signal of rising fear. And finally, let's turn to Asia, where a political shift in Japan is creating its own set of market waves. The surprise victory of Tsuneya Takaichi in the ruling party's leadership race has kicked off what traders are now calling the Takaichi trade, and it's all based on what they expect from her policies.
So what exactly is this Takaichi trade? Well, her platform of responsible, aggressive finance is being read by the market as one thing: more fiscal stimulus. That's weakening the yen against the dollar, pushing the USD/JPY pair past that key 150 level. And at the same time, concerns about more government debt are causing yields on long-term Japanese government bonds to spike.
And this chart really drives home that currency impact. We can see the US dollar's rapid climb against the Japanese yen, which has just fallen to a 2-month low. Now, this move creates opportunities for so-called carry traders, but it also really complicates Japan's inflation picture. Okay, so we've got an incredible tech rally on one hand and a world of political risk on the other. How on earth do we make sense of these conflicting signals? Well, let's try to decode the market's emotional temperature using a couple of key sentiment indicators.
This is really the fundamental question, isn't it? Are investors more focused on the potential rewards from the AI boom, or are they more worried about the risks brewing on the political stage? Is the market driven by fear or by greed? Well, the data gives us a pretty clear answer. The CNN Fear and Greed Index, with a reading of 78, is sitting firmly in extreme greed territory. This shows us that for now, the optimism around the tech and AI rally is completely overwhelming any fears about global political instability. The bulls are definitely in control. Of course, the other massive piece of this whole puzzle is the central banks, especially the US Federal Reserve. Market sentiment is so heavily influenced by what we expect them to do with interest rates. So what is the market pricing in right now? This is the CME FedWatch tool, and it uses futures prices to calculate the probability of a rate move. And as we can see, the market is pricing in a 75% chance of a rate cut at the next FOMC meeting. The market fully expects the Fed to step in and provide support, and that expectation of easier monetary policy is a huge pillar holding up this current rally. All right, finally, let's look ahead. This is a fast-moving environment, and the narrative could shift in a heartbeat. So here are the key events and data points we all need to be watching in the coming days. As seen in the information from investing.com, we've got a busy schedule. Today, we're going to hear from 2 FOMC members, Bostic and Bowman, and we'll be listening for any clues on the Fed's thinking during this data blackout. Then on Wednesday, the Reserve Bank of New Zealand makes its interest rate decision. That could have ripple effects on currency markets. And then on Thursday, we'll get the latest US jobless claims, one of the few official data points still coming out. Each one of these is going to be a test for the market's current optimism. And that brings us to the ultimate question that's hanging over this entire market. We have this AI-powered engine of growth pulling stocks higher, and at the same time, we have this heavy drag of political risk pulling them back down. Can that tech engine outrun the political drag? That is the question that is going to define the market for the rest of this year. Thanks for watching. Don't forget to like and subscribe.